Hey everyone, welcome back to another episode of AWM Insights. We've got some new digs. Hopefully it's looking good for any of you all watching on video. Justin Dyer, Chief Investment Officer at AWM Capital, your host, joined as always by Mena, Hanna, Portfolio Manager here at AWM Capital. And we're continuing to jump further in to the conversation around venture capital, accessing venture capital like a pro, like an institutional pro. How do you look at that asset class? How should you think about that asset class, both from expected returns, but also how do you mitigate the downside, right? There's incredible opportunity, incredible returns, but as hopefully people are listening to and picking up on, right, with exceptional returns comes risk, right? And so you have to think about mitigating and balancing that risk. So you're actually taking well-exposed risk. You're taking risk in the right places to earn a substantial return, not just taking risk to take risk, really. So we're going to jump into a couple really additional important components of this conversation today. I think when we wrapped last week, we started to touch on vintage diversification. We certainly touched on diversification. I know vintage diversification was part of it, but it extends way beyond that, right? There's all sorts of different ways to look and think about diversification within the world of venture capital, right, Mena?
Yeah. And you can think about it as sector. One of the most important things is sector-based diversification. And if you think about, like we talked about last week, venture is a draft. You're not going to go into the draft and draft only pitchers. That's actually something that we see in today's day and age of AI, where a lot of people are going out there and they're constructing portfolios, venture portfolios, solely comprised of AI companies. And that can go well, but if history's taught us anything, that is probably going to fail at some point. You know, you might have some winners, but you don't go into a draft and draft only pitchers or draft only third basemen because you're super hot on third basemen for the next 3 to 5 years. You draft a team, players, ideally the best player in every single position that you actually can draft. And maybe you do skew a little bit heavier one draft towards a certain position, but you can't go all in for an extended period of time.
Yeah, that's right. I mean, it's a great analogy. You don't stack your team in favor. You figure out where you have holes and you try to strengthen those holes. What that ends up looking like is exactly what you're saying, diversification, right? You don't want all AI exposure. You don't want all fintech exposure either, right? There's a strong argument here to cast a well-informed net. I don't want to say a wide net because you don't want to just blindly do that, right? You need to have the data-driven approach, right? So you look at your lineup, where are my gaps, where are my weaknesses, and let's put our chips, if you will, in those categories. So that's a great presentation analogy around sector focus. But again, diversification can be vintage diversification. So a quick refresher there is that's basically each year in which you're deploying or which companies are formed is called a vintage. And you don't know when the huge outliers are going to be established. It doesn't always happen when there's a downturn and capital is cheap. It doesn't also happen when markets are flying high. It can. There's kind of a counter cyclicality to this. So we've talked sectors, we've talked vintages. I think we've also hit on managers, right? We want to cast a wide net around different portfolios of startups. And really what we're talking about there, if you think about venture capital, let's take a step back. We are investing in the next cycle of innovation. And the way at least we take that a step further is to go and make sure we're getting exposure to these networks of innovation or nodes or hubs of innovation. So Mena, maybe walk us through that aspect of it.
Yeah, and there's a few layers there, but you want to be allocated to all of the different parts of venture that you're talking about. One of these different parts is kind of along what you said with hubs, geographical diversification, something that we actually look at. And when we're constructing our portfolio is not going too heavy into Stanford or potentially MIT. there are certain nodes or hubs where we know a lot of very gifted technical founders are going to come from. And they are the most kind of fruitful trees that a lot of managers are harvesting talent from. They're consistently going to these Stanford events. They're staying in touch with potentially students that drop out. Harvard, same thing. Mark Zuckerberg, that is a guy that you probably want to know and keep in touch with if he drops out and starts a company. So staying in touch there, but also making sure that we cast a wide net. Now, I think the benefit of what we do is we are able to pick specialists in each of these fields instead of relying on one person potentially to manage relationships in the Silicon Valley and at Stanford, at MIT, at Harvard. We can establish a well-diversified portfolio of multiple managers that, are in touch with the Teal Fellows, are in touch with Stanford's Institute of whatever, and they can be specialists in these own ponds, in these own fields, and really own those networks so that we can capture and ideally have exposure to the best talent and the best companies coming out of each one of these hubs and nodes.
Yeah, that's right. Great overview. And I think it's also worth noting, maybe folks come from different parts of the country and have the question, hey, is it worth investing in founders coming from, I don't know, XYZ kind of third tier city? And there's certainly a possibility, and a lot of VCs will look anywhere and everywhere for talent. But then often if they find that talent's coming to one of the big urban areas, right? San Francisco, New York, to name a couple. And really the logic there is like, if, for anyone listening, right? If you're playing a sport and you're really good at that sport, you want to be in the big leagues. And that's typically where those networks of talent and skill and competition exist. And so if you're building something, building an AI company as an example right now, right? San Francisco is kind of waning, and now it's all of a sudden back on top when it comes to innovation and AI specific innovation because of this. Anyone building a company in that space, deploying capital in that space is in San Francisco right now.
Yeah, as like a professional baseball player, you can come from a small town, but you are going to move somewhere where you're going to have access to the best trainers, the best facilities, and be able to improve your game, your company, to the highest extent that you possibly can. Founders do the exact same thing. They're going to move to San Francisco because they'll be able to hire the best talent. They'll have access to the best capital. You might be identified in another part of the country, but yeah, what you're talking about is absolutely a dynamic. You will migrate to the most nutrient-rich land in a way.
Yeah, and when we're talking to venture managers, we're asking questions around how they approach this, because we want to make sure they're leaving no stone unturned, if you will, and figuring out how to build and cultivate their network. Maybe it is a strategy that's solely plugged into something kind of really black and white. Y Combinator is a big accelerator that creates companies, and some funds have those type of strategies. You've mentioned Stanford. Some funds focus on universities, some very focused on singular universities. But if we're really focused on this idea of power law, where a small number of outliers account for the vast majority of returns, there has to be this diligence. And it's where diversification really matters and actually leads to better outcomes in venture capital. So I want to go to the power law and let's talk about that, Mena, where, right, you can find talent anywhere, right? Yeah. Anywhere in the draft, as an example.
Yeah, and the draft is a great analogy. You're obviously going to have, look at your Cy Young winners this year. You have Paul Skeens, who is the top overall pick, and you have Tarek Skubal, who is picked in the 9th round, 255th pick of that draft. You are going to be able to find value across the board. And actually, sometimes your biggest winners, when you think about it from a valuation perspective, your bigger winner in that situation is actually Tarek Skubal, because you drafted him with a later pick. You probably paid him less. You got a better deal on him overall. And we look at venture in the same way. Obviously, we do want to have access to the Paul Skeens of the world, and that is going to come at some cost. You're going to be buying in at a higher valuation. You're going to own a smaller piece of the company. Obviously, if it does well, it does well. But your bigger and better outcomes are going to come later in the draft. Ideally, working with the right people, identifying the right talent, buying into these companies at the right prices, and owning a decent chunk of them so that when they do win a Cy Young or IPO, you're truly hitting a home run and you don't own, a micro fraction of a great thing.
Yeah, exactly. Great. That is such a good analogy around the power law. You want to make sure you're getting enough exposure to capture those outlier returns. Sometimes they come from where we think they're going to come from in the top, number one pick, and sometimes they come from, pseudo or seemingly kind of undiscovered places or lower value places. So hopefully this conversation continued to help understand the world of venture specifically, and really the risk and return nature of this, the crazy dispersion you get, the crazy failure rates, quite honestly, in many cases. But if we can capture a wide swath, tilt towards the most important innovation hubs and networks, partner with managers who are leaving no stone unturned, really have this knack for finding founder talent, we do really believe that it tilts the odds in our favor to capture venture returns, which are the best returns out there when it comes to investing over long periods of time, right? You have to be disciplined and consistent allocating this asset class. So we'll leave it there today on venture. We're going to probably pivot to a couple other private market asset classes that most of y'all find interesting and we allocate to as well, and really continue to dive deeper into each one of them. But until then, shoot us a text.
626-862-0355.
If you have any questions, that's the number to use. Topics, feedback, whatever it may be, we definitely want it. We want to make these conversations interesting, relevant to what's top of mind for you all. So please, please, please do use that. But until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.